You good at the back? Good morning, folks, and thank you for joining us in Hammersmith, and welcome to Betfair's preliminary results for the year ended the 30th of April 2014. I'll pass over to Alex in a minute for an update on the financials, but broadly, 18 months ago we set out a strategy. Since then we've reported, I think, consistent progress against those objectives stated then, and today sees a continuation of that trend. Despite a decline of 18% in unregulated revenues from unregulated markets, we've achieved a record profit and record revenue result for the year. And this is primarily down to success in the UK and the United States, our two largest markets. And the growth in EBITDA of 24% comes notwithstanding increased investment in product and brand. So we're happy with the outcome for the year, and with that I'll hand over to Alex.
Thank you. Excuse me. Good morning, everyone. Let's just get right into it. Dispense with the pleasantries. Financial results. FY14 versus revenues, which we feel is exactly what we kind of talked about in the past, and of course there's an 18% decline in the non-sustainable revenues, which we'll talk about a little bit more and what we expect there. Good sporting results helped. Performance of TVG absolutely helped. So those are highlights, and again we'll look at some detail going forward. Operating costs down 5%. This is previously announced cost savings. We did say we've announced 30 million of savings. We've achieved a bit more than that, 33 million. Clearly we're on track. I will say now that, because I know the questions will come, we're defocused from cutting costs. We're really focused on investing in the business and growing the business and improving the operating performance of the business. So the questions of how much more cost do we need to cut should be stopped now. The answer is going to be exactly as I just said. And of course the improved operating leverage performance, you can see the improvement, significant improvement in EBITDA. Effectively for every pound of revenue we get, more of it drops to the bottom line. 23% margin versus 18.9% this year. I think exactly as we were expecting, or we talked about in terms of the margin, and obviously we will talk about more about point of consumption tax, which of course is not in these numbers, right? So there was no point of consumption tax. That will clearly affect the cost and the margin going forward. So obviously the revenue split. Now the good news here is the sustainable revenue growth of 9%. I think another good news here is that if you look at US gaming and sports, all of them have contributed to the growth. Obviously, as Brian said, US and the sustainable markets, mainly the UK and the US, have been the biggest contributors. But the gaming number, which we have always highlighted as one of the big challenges for Betfair, we see some slight improvement in there, and that's obviously very encouraging. Non-sustainable. Now, I will talk more about the 9% growth because I want to touch on this. Actually, maybe I should do it now. This 9% growth. So when you look at next year, when you look at medium term, right? Our expectations are this is the kind of growth we would expect this business to achieve over the next few years. And while I know that a lot of you will look at the Q4 numbers and see a significantly higher growth in sustainable revenue, there are two things we have to remember. There's a tremendous volatility in this business quarter on quarter, and therefore looking at the quarter and extrapolating anything forward is just not the way we think about the business, and quite frankly I think that's just not the right way to look at it. The second thing is that there was a number of things in the fourth quarter that have affected it very positively. Cricket World Cup, there were a lot less horse races cancellations, abandonments than we usually expect. There was a higher sports margin. There was more football fixtures. And in TVG, we started New Jersey ADW business in March of 2013, so you see the full impact of all of this. in this year. So again, let me just reiterate that we view medium-term growth rates in sustainable revenues right at about where we are now, in spite of the fact you see a much greater number in the fourth quarter, right? That's enough of that. On the non-sustainable markets, 18% decline. Most of that decline came from markets you already know about. We talked about Cyprus, we talked about Greece, we talked about Germany, we exited these markets. We've actually been quite lucky this year in that there hasn't been any new markets that have shut their doors to us, so to speak. However, we do not expect that to continue. We have highlighted to a lot of you some developments in Eastern Europe. We talked about Russia. We talked about Portugal. There are other places where we see regulatory developments to possibly affect us unfavorably. Therefore, the 18% is, while again it's very lumpy, and of course there's a lot of uncertainty in this, when we talk about medium-term guidance and we're talking about 15 to 25% decline, we're not just making this up. We see some developments that should give you pause and should make you listen to those numbers, right? There are developments. Regulation on one hand is positive, and places like Bulgaria and Italy, of course. On the other hand, it could affect us negatively. In some cases, the markets are shut. In some cases, the tax regime that's introduced is so prohibitive, we won't participate. So that's very important to understand. And again, I think that now the final thing I would make, the final point I would make on the other markets is that the point that is made down below, it's a lot of countries. Each one of them doesn't account for a lot. There's about 5 that account for between 2 to 3%, between 1 to 3% of revenue. The rest are smaller than that. But obviously, as you start adding them up, there is a significant amount of regulatory uncertainty. This is an important slide, particularly as you look at us, as you compare us to the competition, and when we talk about price rush and we talk about bringing the exchange and sportsbook together. This to me is a very, very key slide. Why are we doing this? We are operating obviously at the lower margin by bringing them together. But why are we doing this? This is one of the reasons why we do this. Our exchange model has lower volatility of revenue than a pure risk model. And you can see what we've highlighted here is 2 weeks that have been called by other bookmakers as black swan weeks. I've never heard that term before, but then again, I'm from Russia. Maybe we use different terms for this. But the point here is that these are the weeks where all the bookmakers have lost a lot of money. And as you could see, we don't lose money in those weeks because our exchange model is different. And so this is a very, very important differentiator of our business, I think. Moving on, costs. We've highlighted increased marketing costs a number of times. We said that New Jersey and Italy both will be multi-year investments. What you see here is you see here in the marketing cost our investment in television in the UK, which we've talked about and Brian will highlight more. And you'll also see our investment in New Jersey. You haven't seen anything in Italy yet because Italy hasn't launched until this year, so there will be a significant ramp up in the Italian marketing this year, right? But let me just say again, reiterate what we've said clearly about Italy and New Jersey. These are multi-year investment projects. We expect these businesses to continue to invest. We invested last year. We expect to continue to invest this year. We're hoping in New Jersey to break even at the following year, and then we'll see how it goes. Obviously, depending on how we do and how the business is going, we can scale that investment up or down, marketing investment. But these are multi-year investment projects, and you see some of that investment, particularly in New Jersey, and as well as our television stuff in the sales and marketing line. Everything else has that beautiful minus next to it. Because obviously we have, this is our cost savings that we talked about coming through. Really all the lines. Obviously headcount was the biggest cost saving across the board, and you can see here 330, roughly 330 on the average lower headcount positions, but facilities, IT, travel, nothing was spared, and I think we've achieved a very good result, and we're not planning, as I said, we're not looking at any more cost savings. We're just looking to grow the revenue and and continue to be an efficient company, an efficient business. CapEx. I think the important point for me here, the majority of our CapEx this year, external CapEx, has been spent, and internal, on product innovation, on technology, TVG conversion to the HD, obviously a New Jersey casino, and on some small numbers on the facilities. So we continue to invest our CapEx mainly in product and technology. The level of the CapEx you see is broadly similar. We don't expect a huge difference from those numbers going forward. And of course, you know, on internal DevEx, our policy is capitalizing development costs is much more strict now. We truly capitalize things that are absolutely, we believe, have benefits in the future years, demonstrable benefits in future years, and you can obviously see the development capitalization coming down, and therefore the CapEx numbers as you see here, and you can see that we expect CapEx of 25 million kind of as an ongoing number. Obviously, if there's something big that we need to do, we'll tell you about it, but this is kind of like, you know, steady as she goes, so to speak. Cash flow. Well, underlying cash flow is up 40%, as we said, 70 million. Strong balance sheet. Brian will touch on it a bit more. Really, again, all of the efficiencies that we have instituted in the business, cash is king in this business as it is in any other business, and we bring that philosophy here and continue to focus on it very hard. Now, just to remind you, in the 12.4 million of cash flow of some separately disclosed items, that's really most of it is the redundancy costs that we have paid this year, which were, of course, taken on the balance sheet last year. Taken on the P&L, I'm sorry, last year, and put on the balance sheet last year as well. And, of course, dividends we all know about. So, in conclusion, sustainable revenue is up 9%, and as I said, let me just reiterate that we certainly expect medium term. That's the kind of growth we're looking for to achieve medium term in sustainable revenue. 30 million cost savings targets has been exceeded, but we no longer focused on pure cost savings, but continue to operate our business efficiently. Underlying free cash flow up, cash balance is up. All of that translated into increased confidence in the business, and therefore translates into increased dividend that we've proposed to the board, and the board has accepted. So thank you very much, and over to Brian.
Thank you, Alex. So just talking about the business, or reviewing the business a little bit more broadly, we set out our stall in December 12 and revisited that last summer, and a year on, I think we've made pretty good progress. We're seeing some acceleration in terms of the delivery of what we hope to achieve. The focus on sustainable markets seems to be paying off. The business is more stable today. We're more focused on operating the business as opposed to trying to mitigate legal risks. And I think that we're investing with more confidence because we have more certainty of outcome. We said 18 months ago that the product and the brand needed some work. We've been pretty focused on that. The product team in particular have done a great job, but equally I think our branding has been refreshed, and we're getting increased cut through from that. We continue to spend with growing confidence on marketing, some 124 million last year, and we think that shows that we're a top-tier player in this business as it gets increasingly competitive. And equally, we're taking advantage of sensible international opportunities. I think last year was the first time in quite a while where we had new market entries, but launching in New Jersey, in Italy, and then recently in Bulgaria, it's an exciting time for the business. There'll be hard work and there'll be startup losses associated with these, but it does give us diversification in the medium term. And that's all underpinned with a continued focus on doing this efficiently, as Alex has talked about. And highlighting the UK and Ireland, the focus is paying off. We're seeing continued growth in activation, so in new customers. We're holding on to those customers, and we're seeing that feed through to revenue growth. So basically, as we hoped and as we said we intended to do, focus on different parts of the acquisition funnel, or the whole customer funnel, is paying off, and critically we're retaining those customers and getting revenue growth. And this has been facilitated by the sportsbook, and we see ongoing momentum there. And we started last financial year with a pretty generic sportsbook offer, but I think having focused on that considerably over the year, today it's competitive. The guys internally talk about how A year ago, we were sort of aspiring to be a mid-table operator, whereas now we're aspiring to be a Champions League qualifying contender. So I think we've moved up in terms of the pecking order, and there are now points of difference with the Betfair Sportsbook, and in some cases, superiority against some longer established competitors. Mobile continues to be a focus of considerable energy here, and I think is a particular strength. I'll remind you that we do the majority of our mobile development internally, where it's led by the team in Porto, and that means that we're building product quickly and efficiently, and able to respond very quickly to customer feedback. So we've launched a new suite of mobile products in advance of the World Cup, but we'll be launching a new improved app next week again, where just early indications were that there were one or two things we should fix on the mobile sportsbook. And I think that ability to be responsive to customers is helping us get traction. And all of this has been done with robust risk management. If you'd asked me about my fears coming here 2 years ago, trying to build fixed odds capability wasn't something we had it wasn't something we had any right to be certain about, but we've done that, as Alex showed, within margin that's consistent with the rest of the industry, and indeed achieving that without some of the volatility that others have experienced. So that gets us to what we did, and now at last some of the product innovations are beginning to come through, and this, as you know, is the history of Betfair. It's our pedigree, it's our heritage, it's what we really should stand for. We can talk about several things. We can talk about cash out. Cash out, if anything, you know, if Betfair was first with betting and running but didn't ultimately own that in the consumer's mind, cash out is something that I think we delivered first and have made a better fist of owning in the consumer's mindset. We've had 30 million plus cash outs to date. You can see from Twitter and Facebook that the whole cash out thing is seen to be part and parcel of the Betfair, unique to Betfair. And we continue to focus on that. So cash out plus, you can think of as a fractional cash out or a partial cash out. This is today unique to us. There's complicated technology here. If you think about how bookmakers talked about over the last couple of years, they had to scale their operations for Cheltenham and for Aintree for high volume racing days. I can assure you that the technology required to refresh your soccer pricing on multiples with 10 minutes to go on, or 10 minutes left in the games on a Saturday afternoon, is every bit as complex. So we've built IP here. I think we've delivered it to the customer in a more user-friendly way than in the past, and we continue to be quite excited about our ability to differentiate using technology. And Price Rush is something we talked about back in the spring. It launched at the end of January. It's still early days in that there's still a lot of the sportsbook that we can't offer it to. But what that does is give an opportunity for sportsbook customers to capture some of the value on the exchange, and to do that without forcing them to an educational process where they have to learn a new product. It's gone well. About 35% of bets that are eligible are now being price rushed. That's 500,000 bets so far. The qualitative research is encouraging. So about half the customers who have experienced a price rush they tell their customers about it. So we feel that for the first time in quite a while, we're setting the agenda for the industry in terms of product, and that we're articulating that we're articulating that to customers with more confidence, more clearly than in the past. And if we can do all of that and also, you know, feed some of that liquidity into the exchange and leverage our core, less volatile model, I think we look forward with some confidence. And marketing is obviously, in this kind of very fragmented, competitive consumer industry, marketing is a critical part of that. We have talked earlier about how we've increased the marketing spend. As you know, we've refocused that spend away from markets with less certainty, largely back towards the UK. We think it's beginning to work. We are investing with more confidence. We're going to double our share of voice, as we said previously. But the middle chart there, where we show that we're regaining some marketing awareness and seem to be doing that faster than some of our better known competitors, is encouraging. And we talked about the activations, but that ultimately, we think, a leading indicator. We have to compete for customers there, and then if we can retain them, as we're doing, and retain them longer, as I think we're doing, we're encouraged by that. And then social media, you know, some of our competitors do a fantastic job there. I think our ambitions to catch up are in good shape, but, you know, we're not market leading yet. So we're second, I think, on Twitter during Cheltenham. But we're trying to find a place here where Betfair can distinguish itself as being a different brand, being more innovative and more digital perhaps than some of the multi-channel ones. And there's some traction here. Critically, the skill set that we are developing here is also of use to us in the other parts of the business. So we have part of the reason we have performed well in New Jersey has been we've leveraged the social media skills that have been developed here in Hammersmith and in Dublin. And that's obviously helping us with TVG as well. I could take you through some of those, but telling you how brilliant our app is sounds self-congratulatory. There is one somewhere about how one of our competitors has to sort out the fact that they haven't got cash out working properly. But you can see this for yourselves on Twitter. I think that's a reasonably representative example. And gaming is improving. Alex talked about how it still is. We still feel there's room to go there. We had good traction in Q3, which we reported then. That was against soft comps. We saw a slowdown in that in Q4. But the underlying metrics in terms of cross-sell is improving. That's because we're getting the basics right. We're improving the wallet. So we had seamless wallet from, as noted there, in September, which basically means that customers were no longer forced to decide how much money they were going to transfer to the casino. The CRM processes improve. Cross-sell is improving on the site in terms of how we're using assets and sports traffic, how we're pushing the right gaming messages to them at the right time of the day. So sustainable gaming revenues was up 2% in FY14. That included double-digit growth in the second half. We still have work to do there. And mobile, as I said, continues to drive revenue growth. We were early in mobile, and our products are strong. I think doing the work internally is a huge advantage. And we've refreshed most of our product suites for the World Cup. So a 70% increase in mobile revenue over the year to 80 million is a good outcome. The majority of our customers now use it, and it's the primary channel. As you can see there, 64% of sportsbook customers use mobile in Q4. It's the primary channel for engagement, and I think the investment is I think that's a very sensible place for us to be investing. After 7 years, or 8 years, after fighting in Italy longer than the duration of the Second World War, we were delighted to launch the exchange at the end of April. It came, as Alex said, a little bit later than we had expected. We still have stuff to do to bed it down. As you know, it's ring-fence liquidity, which isn't brilliant, but we're still delighted that it's launched. Interestingly, pricing is quite competitive. So the pricing is very close to the .com pricing, but liquidity is not as deep. We're continuing to talk to individuals who will act as market makers in that market. And we have continued work to do in terms of product. And I'm happy to talk about the complexity of perhaps the most regulated market in Europe and the implications for product with people after this session. But largely, it has been delivered. There's a lot of work to do. We're starting to advertise during the World Cup. My personal view is that we won't really have a view on this until late on in the calendar year. I think it's too hard to extrapolate from whatever our experience is during the World Cup, and then there will then be 6 weeks downtime until the soccer starts. So I would expect that by the beginning of next calendar year, we'll be in a better place to give you a view on that. And TVG continues to improve. Handle is up, revenue is up strongly. ADW in New Jersey, so that's the contract we won to run the ADW business, the Advanced Deposit Wagering business for the state of New Jersey. And we started that in March of last year. So there's a lapping there's a full year effect in our Q4 numbers. But the guys have executed very well there. We guided in the past that the margin levels in TVG should get to the margin levels of the group, and that's been achieved. And that's been achieved with continued investment. So there are 2 TV racing channels in the United States. We're now HD, so high definition, and we think that is better for our customers and ultimately better for our business than the other channel. We've also signed a deal with the Hong Kong Jockey Club where we uniquely commingle bets, horse racing wagers in the United States into the Hong Kong pool. We think, again, that's advantageous for our customers and our business. And the New Jersey casino launched on time in November 13. And the market has opened more slowly than anticipated. There's well-documented stories about payment and geolocation issues. But the Betfair brand has started well. We've leveraged the product experience of here and some of the social media experience and some of the operation experience from Los Angeles and Oregon. And I think we're happy. It's a solid start to have a high single-digit percentage of the casino market for an unknown brand. it remains an exciting market. Optionality of other states in the US remains exciting. And of course, in the medium term, there's some aspiration to get a horse racing exchange in the United States. So we're happy with the progress so far. So then in summary, we have momentum. There remain challenges ahead, but we have momentum. And in the UK, we're now growing, we believe, sustainably. And in that most competitive of markets, I think we've shown that we have the right to compete and the right to grow. We see the business increasingly as being growth-oriented. Alex made his views on cost-cutting clear. Of course, we'll continue to run the business efficiently, but we're now ever more focused on the top line. And we do that with confidence, given the investment in sales and marketing of 124 million last year, and with a similar or greater figure this year, and the ongoing technology investment as well, both in product and underlying technology, and with new market launches in New Jersey, Italy, and Bulgaria. The product differentiation stuff we think is beginning to work. At least it's helpful to have something unique and sustainably unique and different to talk about. And on the balance sheet, we have decided, we talked about it 12 months ago, and we've decided at this stage to retain flexibility. We talk about this being remaining under review, but with less than 6 months to go to the arrival of the tax in the UK, with the expected disruptions that will come from that, the board has concluded that retaining flexibility at this stage is the right thing to do for our shareholders. We're on the record as saying that we understand that when the company and when the industry reaches some kind of steady state, that excess cash would be returned to shareholders. We remain of that view, and I guess we will discuss this again in 6 months. So in terms of outlook, we continue to forecast to grow sustainable revenues in line with the market. We do think that caution should be applied to the unregulated stuff. As Alex said, we had a pretty good year last year with just an 18% decline and no major market exits. But there's enough, this is not just a one-way bet, and as markets open up, we expect other markets to close. And of course, the arrival of the tax, which would be some 36 million on a full year basis, or on the FY14 revenues, comes in December. So we're happy with where we are, but we remain cautious about the outlook. And with that, I'm happy to take questions.
Hi, it's Vaughan Lewis from Morgan Stanley. You said TVG margins are in line with the group, so that suggests about 10 million of EBITDA there. So New Jersey's losing 8 million on 2 million of revenues. What's the sort of profile here? How long do you give it before you change the strategy? And will the losses be reduced this year? You said break even in F16, I think, but will it be lower this year?
So New Jersey's open now, Vaughan, just over 6 months. There were teething issues for the entire market, which are pretty well documented. We've talked about this being a multi-year investment, and we still see this as being a multi-year investment. So we'll continue to invest this year and next year, and get to this. We hope to get this business to break even in year 3. That remains the case.
Will it be a higher or lower loss this year?
I just can't give you guidance on that as yet. You have to understand this market there are considerable unknowns. We have yet to see how the online market trades through a summer. Typically, that's been the strongest period for the land-based industry in Atlantic City. But, I think we're competing well. We have flexibility in terms of approach, and we'll invest if we believe we're going to get a good return on that investment.
Okay. And then on the integration of the sportsbook and the exchange, can you just say how that actually happens? Does the bet just pass straight through to the exchange, or do you take a margin on the way through? And what's the impact been on exchange volumes? It looked quite healthy in Q4.
It is additive to the exchange volumes, but the exchange is so big relative to the sportsbook that it isn't changing the outcome for the exchange just yet. Broadly, we accept the bet. We then instantaneously check whether there's better value available on the exchange for the size that's required for the sportsbook. We work out an inferred commission rate as if the probability of that bet winning, and the implied commission that would have been paid if that bet won on the exchange. And then if there's value, we pass it through to the customer. We make decisions on what markets Price Rush is offered on. So we can't offer it on everything. We can't offer it on each way racing at the moment, for example. And we see that it is more prevalent. The likelihood of Price Rush happens more on things like correct score and first goal score and stuff. But, a growing number of customers get this. We're still working out how to optimally use it. It's one of the promotional tools available to us, but it's not something that we should offer always on top of everything else.
Is it fair to say that the main sort of thrust of it is to get the attractions of the exchange on a more easy-to-use basis for mass market, and that's so people will start using the exchange without knowing they are effectively?
Well, in effect, the main attraction is that it, A, gives more value back to the customer, B, educates the customer that there's something different and unique about Betfair. And it has the extra benefit that it lowers volatility for us. It's not free for us, because if we bank those bets on the sportsbook, we would probably do so at more margin. So we're still working out how best to use this, how best to deploy this, where we get compensated by customers transacting with us more and staying with us longer.
Great, thanks.
Morning, it's Ed Birkin from Credit Suisse. Just following up, I know that you said you can't talk about the New Jersey particularly, but on the interims, Alex said that the losses from New Jersey, Italy combined would be higher in FY15 to 16. Is that still the case?
Sorry, what?
The losses combined from Italy and New Jersey will be higher in FY15 than FY14 was your previous guidance. Is that still holds?
We never talked about New Jersey. We talked about together New Jersey and Italy.
Yeah.
Right. To be honest with you, I can't answer that question at this point, because I think, as Brian said, the markets are very fluid. Depending on how the growth goes and the revenue growth, we will ratchet it back and forth. There are very different markets. There are very different stages. So I wouldn't be able to answer that question at this point.
Italy is interesting, right? So we launched, it took longer than we thought. We eventually launched. There's now 2 betting exchanges, so Betflag have also launched, but the regulations are different for the exchanges and the sportsbook. We have yet to roll out the complementary palincesto, which is the product, the additional product that some of our .com competitors are generating 40% of their volume through. So we've yet to roll that out. And to roll that out, we have to go through a testing process, and that's somewhat outside of our control. When you get into the nitty-gritty of exchange regulation, curiously, the way it works is that deposits on the exchange can't be withdrawn. So you deposit 100 euros, you bet on Chelsea, you win 50, you can't withdraw your original deposit. That just happens to be the way the law is. Now, the law will change, or has changed. We'll have a release in the next 2 weeks to fix that. But right now, they're the rules on the exchange. So we have to bed this stuff down. There's no point spending marketing until we're happy with the product. We'd love to give you a bit more visibility on it, but some of this stuff is dynamic, and we have to engage with regulators. And New Jersey, it's a different set of issues, but there's equal local market complexity there. And in New Jersey, the whole market is trying to sort these things out, whereas in Italy, we're just the one exchange or one of 2 exchanges in a more mature market. So we see these as multi-year investments. We do that with confidence, but it's tricky at this point in time to know exactly how we'll face that.
Okay, and then in terms of the investment in the underlying business that you finished cost cutting, pre the incremental tax, should we expect operational gearing in the business?
Pre-tax?
Yes.
I think that we've showed that we can do it pre-tax, and I would not expect anything less.
Okay, and then finally, just in terms of potential use of cash, do you have parts of your technology that you currently outsource that you would ideally want to internalize, or are you okay in the technology department?
I'm very happy with our technology department. They're doing a smashing job. We're not going to be drawn on the uses ahead. We've talked in the past about how the cash could be deployed to either address product gaps, or to accelerate or de-risk market entry, or to build out skill sets that complemented what we have. I think we're showing that we can compete organically, but we will review this. We'll continue to review this and continue to update the market when we can.
Thank you.
Morning, it's Nick Edelman from Goldman Sachs. Can I just ask one follow-up on the operational gearing point? In terms of how you think about your different cost lines and how they might vary based on revenue growth, if I were to assume that your marketing costs will probably be quite variable, in terms of the other costs, so in terms of your operations costs, is there much more cost that you could add in were revenue growth to accelerate? Is there a list of 10 things that you'd like to do? At the moment, you're planning to do 5, but given the opportunity, there is scope to reinvest revenue growth. Basically, I'm just looking at, are they variable or are they relatively sort of fixed costs?
The biggest thing is new markets opening, right? Because if you look at what we talked about New Jersey, if you looked at what we talked about Italy, we're hoping for more markets opening. Every market that opens requires an upfront investment, both in technology and market.
Nick, we obviously asked that question of each other and of the management team. So how would you deploy more cash internally? How would you spend more money on product? How would you, where else would you put resource? Alex is right. We have our hands full right now. We've got 3 new markets of different sizes and different complexity. So we think about that, but I just don't think we can be drawn to that right now. Your more general point, as we have more on marketing, as we have more certainty of outcome and we see momentum, we have flexibility here to ratchet that up and down.
Hi, morning. It's James Hollins from Investec. Just 2 questions. The first one's on UK Sportsbook market share. I was wondering if you could give any idea, or if you had any idea where you are in that respect and what we think, or you think you could get to over the next couple of years. And then the second one would just be on the cross-sell initiatives. I don't know if I missed it or you slightly skimmed over what you've done there or what you plan to do, but I'd love to know a bit more on exactly how you're going to push that further.
The cross-sell is more, I talked about doing the basics better. So we weren't always brilliant at, gaming was kind of the unloved child in the business. We got better at that. It got more focused and the guys sorted out the operational processes. But it still took considerable force to actually cross-sell gaming onto the sportsbook and onto the exchange. We're getting better at that. We've removed some of the technology impediments where it used to be that you had to decide how much money you were going to transfer to the casino before you could play on the casino. And that was, internally people talked about, you decided how much money you were going to lose on the casino before you started to play on the casino, whereas now it's a fluid transaction. So we see that as doing the basics better. I think on mobile we're doing better than that. I think the way that on the new Sportsbook app, the way you can change, you got sustained or persistent login between the different apps, I think is very good progress. On market share, it's tricky. We feel we have benefited from good results over the last few months. We feel we have seen evidence of recycling over the last few months. If you go and look at the chart, the volatility chart, the best week there followed one of the so-called black swan weekends. That's not 100% consistent with some of our competitors are saying. So I don't want to extrapolate market share at this stage. Maybe that's something when we see how they've traded over the next few months in post-World Cup, we can express a view on that. So we look at, market share on the sportsbook is one dimension of this, but we really look at this as just a sports business, and whether it's sportsbook or exchange or sportsbook through to the exchange, we see these increasingly as the one thing, and we run this as the one thing, and gaming falls in as part of that as well. So that's why when we talk about guidance, we talk about participating in market growth in the sustainable markets, as opposed to on a vertical by vertical basis.
Hi, it's Joe Thomas from HSBC. Just back on the costs, and I know you said that there are no more costs to come out, but presumably one should have a sense that there's some cost to automatically drop out as a result of the point of consumption tax. I mean, everybody else is talking about switches being flicked and payouts to affiliates and other suppliers are diminishing as well. Is that something that you're seeing? I mean, you had prompted, or could you quantify that? And you had anticipated giving an update on point of consumption tax mitigation, I think, at these results. So could you just flesh out your latest thoughts?
Yeah, so I think the point we're making, so I think we've shown evidence that we run the business in a more disciplined way. I think we have shown and talked about again this morning how we think about operational leverage. We see that operational leverage is obviously being easier when you're growing revenues. I don't think we can be drawn right now on how much of this gets passed on to suppliers or how much of this changes in terms of marketing. You have different messages coming from different competitors, and we reserve the right to compete, and we reserve, we have thought through this, but we'll know an awful lot more about it in 6 months' time. So in the round, we think about we have invested in marketing and product and people. We're seeing top-line growth. The tax will fall out. we will do what we can, obviously, to run the business efficiently. We're also worried about the regulated stuff, but I don't think that at this stage we can just highlight one line in the P&L, which is the tax, and say that we can mitigate without that being in the context of what goes on from a regulatory perspective and what goes on from a growth perspective.
Morning, Victoria Gray from JP Morgan. Firstly, on depreciation, where do you see that for next year, and when do you think it gets closer to the capex number? And then, secondly, on the cash out product, you talked about trying to understand where it was going to generate value. Is that something ultimately you would want to target at an individual customer or an individual group of customers, or do you think it'll always be more about the product and whether the value is there on the exchange?
Well, I'll take the depreciation. I'll be honest with you, I don't focus too much on depreciation. I think it'll be a little bit down on where we are now. When it will reach the capex number, I can't answer that question, so don't know.
I'm sorry, on the cash out, so the cash out is something we offer to all exchange, is offered to all customers exchange on Sportsbook. It has certain attraction. It's more attractive to some customers than others. The price rush thing is where the Sportsbook customers are now unlocking some of the value of the exchange. So I may not have got the gist of the question.
So in making the decision about whether to give the price rush to the customer, could that ever be driven by the individual customer and their profile with you?
Yeah, so we're getting to personalised offers where we can extend some product to individual customers or types of customers, and we're not sure that that's quite what you should do. We're not entirely sure that customers want to be seen as something other than a group that has a certain affiliation or whatever else. There's something odd about bookmakers giving better value to customers where they know that the bookmaker only wins if the customer loses. So, controlling this technology in-house gives us a certain amount of flexibility. The price rush thing is exciting, but it's very early. I mean, we have 3 or 4 months of data. The point I tried to make earlier was that we have to think about these things in the round. So we can't layer promotional behaviour and value on top of value. And it could be. So the offer for the group stages of the World Cup is that if England lose, we'll give you your money back as part of a free bet. Probably giving price rush value on top of that probably is more than we need to do. So we have more tools in our toolbox to allow us to think about what value is passed on to the customer, what value goes to the exchange, and what value we extract. That's what we're trying to do. Sorry.
So, Richard Stuber from Nomura. A couple of questions, please. First of all, on your website, I've seen some sort of chat saying that liquidity is down in some of your markets. I know that things like the price rush should help, and again, you'll say seeding some customers to put liquidity in is also maybe helpful. But is there anything else you could do to increase liquidity in markets? And would that include sort of changing the commission or pricing structure anywhere there? And the second question is about Australia. Given the increase in race field fees, could you say what sort of headwind that would be for this year? And if you comment on any sort of talks that you may be divesting it back to Crown.
Yeah, so liquidity moves around, and the truth is some of our customers are ambivalent about where the other customers come from. We, on the other hand, have to take a little bit of a more responsible view on that. So as we've left the unsustainable markets, that has hurt liquidity, and in certain sports it has hurt more than others. The volumes on the exchange, the bet volumes on the exchange are hitting all-time highs. So the exchange fundamentally is busy, very busy. And that's because of some of the new products like cash out and because of the growing customer sophistication. So liquidity is a metric, volume is a metric, but I think revenues ultimately are the metric that matter most to us. And we're doing some of the things you talked about, encouraging customers to seed and whatever else. I don't think that necessarily gets you to a pricing discussion. We've talked about that in the past, but I don't think we'll talk about that much more. The second question was... I'm sorry, Australia. Yeah, the guys... look, Australia, the business is solid. The guys are investing down there. The price fees is not great. but it's only it's a couple of handfuls of races in Victoria, so it's not as bad news for us. It's incrementally not as bad news for us as when the product fees were first introduced, and the guys are pretty focused on growing the business, and are getting on with it.
Thanks. Morning. Ivor Jones from Numis. I think the management structure has changed since this time last year. Can you talk about what it is now and why it's better?
The management structure has changed since last year, Ivor. I think organisations need different structures and different designs at different times. And additionally, different people want to work at places at different times of an organisation's development, and different people are called for at different times of an organisation's development. There was a very pragmatic decision made to carve out the sportsbook in gaming 18 months ago. We talked about how the gaming was the unloved child of the family. Sportsbook had existed in one shape or form here for 5 years, but had never been resourced to actually give it the chance to properly flourish. I think under Mark Brooker and his team, they did a smashing job with the sportsbook. So I think we have the right shape now. We're running the business as one P&L, and I think the momentum of the last few quarters is encouraging.
So why is gaming doing better now under this structure than under the structure you originally set up to grow it and give it attention?
I didn't say it was all down to structure. I think some of it was some structure stuff helps make decisions more quickly or better. I think the gaming team have consistently over the last 18 months focused on improving product. We don't control all of the product in-house, as you know, so it's easier to fix things that are internal. But the gaming guys have been against tough headwinds, poker, and that gaming suffered more than the exchange did and more than sports did from the market exits. I'm pretty happy that they're getting on with it. They feel they have more to do for us, and I'm delighted to encourage that.
And I think the new structure assists cross-sell opportunity better, because you have a different structure, different way of looking at it, and so the cross-sell becomes it was always primary way that the gaming was going to grow, but under the new structure it has even an increased focus, which I think is what's helping.
Okay, thank you. And trying to think through the next year and beyond about what the business looks like. A couple of numbers in my mind are that revenue in sustainable grew 26 million, and you spent 184 million of marketing and technology cost. And this year you're going to spend more, and the return on that's going to be worse if you're right and point of consumption duty comes in. So these are expensive years for not much return. What do you think maturity looks like? Better revenue growth, less spending to get there? Or is it always going to be hugely expensive to drive relatively modest growth?
No, I think that when we get through the taxation and the market structure stabilizes, I think that we will have the aspiration to continue to grow in line with the market, as we said, and that in a post-tax world that we should see operating margin expansion as well. We're kind of 6 months from the start of this storm. It's somewhat hard to look through it, but in the medium term, I'm very comfortable that this business can create value that way.
And following on from Richard's point about the exchange, you're going to report sports and exchange together. Change in reporting is usually a sign that something's going wrong. The exchange is still big. Why? And I get there's volume issues, which Richard's highlighted. But if it didn't grow last year, when you were spending all this money on marketing and technology, why shouldn't we be worried it goes down 5% for the next few years? Can you even hold it stable? What's wrong in the exchange part of the business?
So, I mean, Ivor, I have too much respect for you to tell you what to think. We have confidence that we can grow. We've stated, we've been pretty explicit about how confident we are. The exchange, as you know, is quite mature. The exchange has benefited from the network effect that was assisted by some of the growth in unregulated markets. But we think it's ultimately unique and sustainably unique, and we think that that's a very good platform from which we can grow. Time will tell. I'm not too keen on giving forecasts, but time will tell.
By the way, the only thing I would say is that exchange did grow last year. Sustainable exchange grew last year, right? So it didn't grow much. We hope it can grow more, but it absolutely grew last year. Everything grew last year, sustainably.
A little bit.
Yeah.
But you're talking about a business with a revenue stream with a bad trajectory, and not pressing you to make a forecast, but looking at the last year, is this what you would have expected? I mean, was marketing spend so directed at sportsbook and technology development so directed at sportsbook that exchange was an orphan, and therefore it's inevitable that it grew, to Alex's point, 2% in sustainable markets?
An orphan is much better phrasing than an unloved child. I think customers...
The modern phrase is a looked-after child, actually.
I think customers would say that an awful lot of the investment was on sportsbook. Over a pretty short period of time, we built a quite competitive sportsbook, and an awful lot of the marketing focus was on sportsbook as well. We are happy that these businesses can be run more closely together. Our organizational structure reflects that. I think the price rush shows that these businesses are intrinsically linked, or can be intrinsically linked, and that therein actually that gives us the benefit, or that gives us the ability to differentiate. So we're comfortable with where we are.
Okay, and last one, will you make more on the World Cup than you did on Euro 2012, given what you've spent on?
I don't know. I mean, you know, when you look at Q4 versus Q4, the site was down the Saturday before Cheltenham last year. That had impact over the entire, probably the second half of the month of March last year. If the site stays up and England go well, and customers don't want to go to bed and want to stay up and watch the football, I'm very happy that we'll have a good World Cup. But you know where I stand on forecasts, so ask me in a few weeks.
Thank you.
David Jennings, Davy. Just one question. What appealed to you about the Bulgarian market?
Have you been to Bulgaria, David?
I haven't.
We have a large fixed cost investment in technology and operational capability, and actually a lot of our marketing spend, a lot of our marketing capability scales across geographies as well. So we think that being early in Bulgaria should allow us to get to a profitable business. It may be that it's a profitable niche as opposed to a profitable, you know, very mass market business. But we think that these things have to be looked at very carefully. We think that diversification, geographical diversification in a world with heightened tax risk is also a good thing. And therefore, we were happy to go into Bulgaria.
Thanks.
Jeffrey Harwood from Oriel. It seems to be accepted that there will be consolidation in the sector post the points of consumption tax. But how quickly do you think that will occur, or do you think it could be quite a sort of drawn-out affair, please?
Your guess is probably better than mine, Jeffrey. You know, there are small moves and people, some small businesses changing ownership or shifting ownership percentages. It is undoubtedly getting tougher for the small guys. There's just no question. The tax would accelerate that. And we continue to be pretty relentless about investing in product and, to Ivor's point, marketing. So I think this business is in good shape. But how quickly other corporates act and how quickly market structure changes is very hard to forecast. Okay. Sorry, Ed.
So just follow up with Gerald, actually. You mentioned when you first started that it was quite a stingy dividend yield at Betfair. Once the company reaches steady state, do you think that only paying out a third of your free cash flow as dividend is the right way to go, or would you expect an ongoing dividend perhaps to be much higher for shareholders? Thank you.
Well, we've talked about a progressive dividend policy, and it has grown hugely over the last couple of years. We've talked about dividend cover at 2.5 times, which I agree is quite cautious given the cash conversion rates that we achieve. But we have got storms coming up, and the 54% increase in the dividend was pretty chunky. And we've got more in our locker if we decide that that's the way we want to go.
Thank you.
Great. Well, I think we can wrap it up there. We're not taking questions from the phone, right? No. Great. So thank you all. We're available all day if it's helpful to you. Alex, myself, Gerald, or Paul. And thank you for joining us.